You walk into your bank branch or you log into your mobile app and you see a number. That number represents your life savings. It represents the hours you worked, the sacrifices you made, and the future you're building for your family. You believe that number belongs to you. You believe that the bank is just a vault where your money sits waiting for you to withdraw it. You are wrong. The moment you handed that cash to the teller, or the moment that direct deposit hit your account, that money ceased to be your property. It became the property of the bank. You are not a depositor in the eyes of the law. You are an unsecured creditor. And in the next financial crisis, the law says they do not have to give your money back. They can use it to save themselves. I am Tom, and this is The Wealth Collapse. Subscribe now to stay ahead of the curve, because when the history books are written, you will want to be one of the few who saw it coming. Most people are familiar with the term bailout. We saw it in 2008. The big banks gambled recklessly with toxic mortgage-backed securities, and when the bubble burst, they went bankrupt. But because they were considered too big to fail, the government stepped in. They took taxpayer money and handed it to the banks to fill the massive holes in their balance sheets. The executives kept their bonuses, and the taxpayers were left with the bill and the inflation that followed. The public outrage was massive. People marched in the streets. They demanded that this never happen again. They demanded that taxpayers should never again be on the hook for the mistakes of Wall Street. The politicians heard you. They agreed with you. They passed new laws promising that there would be no more taxpayer-funded bailouts. In the United States, they passed the Dodd-Frank Act. In Europe, they passed the Bank Recovery and Resolution Directive. But here is the trick that they played on the public. They did not make the banking system safer. They simply changed who pays the bill when the next crash happens. They replaced the bailout with the bail-in. To understand the danger you are in, you have to understand the legal definition of your relationship with the bank. When you deposit money, you are legally lending that money to the bank. The bank gives you an IOU, which is the number you see on your screen. In a normal bankruptcy, there is a hierarchy of creditors. Secured creditors get paid first. These are people who have collateral. Then comes the bondholders. And at the very bottom of the pile are the unsecured creditors. That is you, the depositor. The bail-in protocol is a legal mechanism that allows a failing bank to restructure its capital by canceling its debts to unsecured creditors. Since your deposit is a debt that the bank owes you, the bail-in allows them to simply wipe it out. Or in some cases, they convert your cash into equity. Imagine waking up one morning and checking your account. Your $50,000 is gone. Instead, you have $50,000 worth of stock in the bank. But because the bank is failing, that stock is essentially worthless. You cannot buy groceries with bank stock. You cannot pay your mortgage with bank stock. Your liquidity has been stolen to recapitalize the institution. This sounds like a conspiracy theory or a dystopian nightmare, but it has already happened. It happened in Cyprus in 2013. This was the test run, the blueprint. Cyprus had a bloated banking sector that was overexposed to Greek debt. When the crisis hit, the banks were insolvent. The European Union and the International Monetary Fund refused to provide a full bailout. Instead, they forced a bail-in. It happened over a weekend. On Saturday morning, the government announced that the banks were closed. The ATMs were shut down or ran out of cash. Online transfers were blocked. Panic set in. People rushed to the branches, but the doors were locked. For 2 weeks, nobody could access their money. When the banks finally reopened, the reality set in. Depositors with more than 100,000 euros in the Bank of Cyprus saw 47.5% of their savings confiscated. Gone. Just like that. It was not a tax. It was a haircut. The money was taken to fill the hole in the bank's balance sheet. The media at the time tried to spin this as a unique event, and they said Cyprus was a special case because it was a tax haven for Russian oligarchs. They told the American and British and European public not to worry. They said, your money is safe. But that was a lie. While the media was calming the public, the technocrats at the G20 were rewriting the global banking rules to make the Cyprus model the standard for the entire world. In 2014, the G20 leaders met in Brisbane, Australia. They signed an agreement on the adequacy of loss-absorbing capacity of global systemically important banks. That is a mouthful of bureaucratic jargon, but the meaning is simple. It officially enshrined the bail-in as the preferred method for dealing with bank failures. They agreed that banks must have bail-enable bonds and liabilities. Your deposits are those liabilities. In the United States, the Dodd-Frank Act of 2010 created the Orderly Liquidation Authority. This gives the Federal Deposit Insurance Corporation the power to seize a failing financial company and unwind it. The language of the law is very specific. It talks about imposing losses on shareholders and creditors. Remember, you are a creditor. The goal is to resolve the bank without using taxpayer funds. If they cannot use taxpayer funds, where does the money come from? It comes from the creditors. It comes from you. You might be thinking, but wait, I am insured. The FDIC covers me up to $250,000. This is the security blanket that keeps people sleeping at night. But we have to look at the math of the FDIC. The Deposit Insurance Fund does not have enough money to cover a systemic collapse. They hold about 1% of the total insured deposits in the United States. 1%. If a small regional bank fails, the FDIC can cover it. They can sell the assets to a larger bank and make the depositors whole. We saw this with Silicon Valley Bank. But what happens if a giant like JP Morgan Chase or Bank of America fails? These banks have trillions of dollars in deposits. The FDIC fund would be wiped out in minutes. They would have to go to the Treasury and ask for a bailout, which requires Congress to approve printing trillions more dollars. But the political appetite for that does not exist. The whole point of the new laws was to avoid that scenario. So the system is designed to trigger the bail-in before the insurance payout becomes necessary. Furthermore, the risks facing the big banks today are not just bad loans. The risks are in the derivatives market. The global derivatives market is estimated to be worth over $1 quadrillion. That is a 1 followed by 15 zeros. It is a massive web of bets on interest rates and currency fluctuations and stock prices. These banks are all counterparties to each other. If one major bank fails, it triggers a chain reaction. Warren Buffett called derivatives weapons of financial mass destruction. In a derivatives implosion, the losses would be so large that no insurance fund on earth could cover them. When that day comes, the bail-in will be the only option left on the table. The regulators will look at the balance sheet. They will see a hole of $500 billion. They will look at the liabilities. They will see your deposits, and they will press a button. It will likely happen on a Friday evening after the markets close. You will hear rumors on social media. You will try to log in to check your balance, and you will see a maintenance message. By Monday morning, the new reality will be in place. This process is legal theft. It violates the fundamental concept of private property. But it is justified by the logic of the system. The system believes that the survival of the bank is more important than the survival of your savings. They call these banks systemically important. That means they are the arteries of the economy. If the arteries stop flowing, the body dies. So they are willing to sacrifice the blood of the depositors to keep the heart pumping. We have to look at the terminology they use. They call it a recapitalization. It sounds technical and boring, but for a retiree who just lost half of their nest egg, it is a catastrophe. It means they cannot pay for their care. It means they cannot leave an inheritance. It means poverty. The bail-in protocol also explains the war on cash. Have you noticed how hard it is to withdraw large amounts of cash from your bank lately? If you go to a branch and ask for $5,000, they look at you with suspicion. They ask you what it is for. They might tell you they do not have that much cash on hand and you have to order it. They file suspicious activity reports. Why are they making it so difficult? Because physical cash is the only way to opt out of the bail-in. If you have cash in a safe at home, you are the owner of that value. There is no counterparty. If the bank fails, your cash is still there. But if your money is digital, it is trapped in their system. They need to keep you in the digital pen so that when the shearing time comes, you are there to be sheared. This is why they are pushing so hard for a cashless society. This is why they are developing central bank digital currencies. A fully digital system is a system where a bail-in can be executed instantly and perfectly with no escape. Imagine a world where cash is banned. You have no choice but to keep your money in the bank or in the central bank digital wallet. A crisis hits. The government decides that to save the system, every account must take a 10% haircut. In a physical cash world, people would run to the banks to withdraw their money before the haircut happens. This is a bank run. It forces the banks to be honest. But in a cashless world, there is no bank run because there's nowhere to run to. You cannot withdraw. You can only watch as your balance is reduced. The bail-in is the ultimate tool of financial repression. It shifts the risk of the casino from the gamblers to the innocent bystanders. The bankers get the upside when things go well. They get the bonuses and the stock options. But when the bets go sour, the depositors get the downside. It is a privatization of profit and a socialization of loss, but in a way that is much more direct and brutal than the inflation tax. We are seeing signs of stress in the banking system right now. The commercial real estate market is collapsing. Office buildings are empty. Loans are coming due and cannot be refinanced at these high interest rates. Regional banks are loaded up with this bad debt. We saw Signature Bank and First Republic fail. The government stepped in and broke the rules to save them because they were afraid of contagion. But they cannot break the rules forever. Eventually, the hole gets too big. When the next crisis hits, it will move faster than anything we have seen before. In the age of social media and mobile banking, a bank run can happen in hours. Silicon Valley Bank lost $42 billion in deposits in a single day. This speed terrifies the regulators. It means they have to act fast. They will not have time for weeks of debate in Congress. They will use the tools they have, and the tool they have is the bail-in. Most people suffer from normalcy bias. They think that because their money has always been safe, it always will be. They think that America is different. They think that things like seizing deposits only happen in banana republics or tiny islands like Cyprus. But the laws are on the books here. The infrastructure is built. The legal arguments have been made. The Supreme Court has already ruled historically that a deposit is a loan to the bank. So what can you do? You cannot change the banking laws. You cannot stop the derivatives bubble from popping, but you can change your exposure to the system. You have to reduce your counterparty risk. This means you should not keep more money in the bank than you need for your immediate monthly expenses. The bank is a utility for paying bills. It is not a vault for storing wealth. You need to diversify out of the banking system. This means owning assets that do not rely on a financial institution to exist. Physical gold and silver are the classic examples. If you have a gold coin in your hand, it does not matter if the bank fails. It does not matter if the dollar collapses. That gold is wealth that you control. Bitcoin was created specifically as a response to the banking crisis of 2008. The first block of the Bitcoin blockchain contains a message about the chancellor on the brink of a second bailout for banks. Bitcoin is a bearer asset. If you hold your own private keys, you are your own bank. No CEO can gamble with your Bitcoin. No government can order a bail-in of your Bitcoin wallet. It exists outside the legacy system. You should also look at credit unions. While they are still part of the financial system, credit unions are technically owned by their members, not by shareholders. They tend to be more conservative. They do not have the massive derivatives exposure that the Wall Street giants have. They are less likely to be the epicenter of a global systemic failure. But even then, you are still an unsecured creditor. Spreading your money across multiple banks is another strategy. If you are under the insurance limit at multiple institutions, you are safer than having millions in one account. But remember, the insurance fund itself is undercapitalized. The most important step is psychological. You have to stop viewing the bank as a protector of your money and start viewing it as a risky borrower. If your neighbor asked to borrow your life savings and promised to pay you back whenever you ask, but you knew he was gambling on horse races and owed money to everyone in town, would you lend it to him? Probably not. But that is exactly what you are doing with a major bank. You are lending to a highly leveraged hedge fund that also happens to offer checking accounts. The bail-in protocol is not a possibility, it is a certainty. It is the designated emergency plan. When the next great financial crisis arrives, they will not ask for your permission. They will not ask for your vote. They will simply execute the protocol. The notification will pop up on your phone. Your balance will be adjusted, and the wealth that you thought was yours will be used to keep the casino lights on for one more day. Do not be the unsecured creditor who is left holding the empty bag. Do not be the victim of the fine print. Take custody of your assets. Secure your own sovereignty. The era of blind trust in institutions is over. The era of personal responsibility has begun. I am Tom, and this is the Wealth Collapse. We read the laws that they pass in the middle of the night, so you do not have to. The bail-in is coming. Now you know. The question is, will you leave your wealth within their reach, or will you move it to safety before the lockdown begins? Subscribe now and join the community of people who are taking control of their financial destiny.